After studying this module, you shall be able to know about the flow of funds, learn principle of flow of funds, know the importance of flow of funds accounts, know about the inadequacy of flow of funds data, understand the learning lessons from flow of funds, understand the analysis of flow of funds in the economy. Flow of funds represents amount of funds from different sources in an economy at a particular point of time. To understand the sources, we must clear Indian financial system. The entire financial system of India is divided into two parts. Firstly, formal financial system, and secondly, informal financial system. Further, formal financial system consists of financial markets, financial institutions, financial instruments, financial services, etc. For flow of funds, it means simply inflow and outflow of cash from various sectors as mentioned during the concerning period. To measure the status of flow of fund, one has to take into account flow of fund account, which is one of the tool to assess the financial health of the economy. Hence, one can say that flow of funds accounts give financial data on financial claims, and their result is used as analyzing the depth and maturity of financial markets in an economy of a country. With the help of flow of fund accounts, different types of financial ratios are calculated, which is considered as the indicator of financial development and growth of a country. Meaning, there is a direct relationship between financial development and economic development. If we talk about in the context of today's scenario, the way we have to think about modern flow of funds accounts, that represents a systematic record of net transactions comprising of various sophisticated financial instruments during a given period of time. Therefore, in this respect, a well-established statistical framework for presenting the flow of funds accounts is provided by the United Nations system of national accounts. Hence, it is clear that flow of funds analysis gives a common base for studying a wide range of problems and challenges which basically concerning the financial sectors and its relationship with the economy. Principle of flow of funds. Flow of funds arises due to the transactions which took place in an economy at a particular point of time, which includes buying and selling of goods and services, or transfer or payments of assets and liabilities. Resulting, these transactions generate flow of funds, either inflow or outflow from one source to another source and its corresponding uses. However, at national level, a systematic record is prepared and maintained by the concerning authority about sources and use of flow of funds in terms of different sector wise for an entire economy for a given period of time. Actually, it is a detailed information which cover almost everything which are relevant for the economy as a whole. It is helpful for decision making for the policy makers. The analysis of flow of funds plays a key role for every country, but especially for developing countries because of constraints of resources, whether financial or non-financial. Usefulness of flow of funds accounts. It indicates the role of financial sector in development process of a country. Flow of funds accounts analysis the economic data on borrowing, lending, investment in major sector of the economy. The flow of funds accounts are primarily shows the financial data of an economy wise performance indicators. In India, flow of funds accounts prepared on yearly basis. The flow of funds accounts are prepared by examining the balance sheet of various sectors. Flow of fund accounts is an accounting framework and not a theory or a policy prescription. Flow of fund accounts have been widely used in an industrial economy as a basic information tool. Flow of fund accounts are used to study the pattern of intersectoral financial flow in the economy. Flow of fund account gives the decomposition of sources and uses of methods by which savings are accumulated in different economic environment. The mobilization and allocation of resources are the central issue for development, and properly specified flow of funds tell exactly how financial resources are generated and distributed within an economy. Inadequacy of flow of funds data. As it is clear that in spite of the growth of formal financial sector, informal financial sector is lacking behind for its transformation into an organized financial structure in this country, because informal financial sector also play a significant role for growth and development of country. But unfortunately, due to absence of proper mechanism, such institutions are not directly taking participation in the financial program of the country. That is why we can say that flow of funds accounts can be improved further if informal financial sectors are positively taken. Hence, the data shown in flow of funds accounts or metrics are not adequate because it is not containing the information of informal financial sector due to technical issues. Therefore, there is a greater need to formalize the informal financial sector into formal financial sector for the better functioning of economy. Learnings lessons from flow of funds. One has to clearly understand that flow of funds is not a hypothesis or a policy prescription, but in general it is rather a framework for thinking about a range of economic issues and challenges. Particularly, it does not mean that macroeconomic problems are exclusively solved using this approach, that is flow of funds approach. As far as learning lesson is concerned, for the developing nation, especially countries like India, where flow of funds analysis are concerned mainly with policy problems which are linked to methods for improving monetary system, fiscal policy and resulting economic performance, and after all the goal of economy is achieved, that is improvement in standard of living of the people of that country. Analysis of flow of funds in Indian economy. In the words of Reserve Bank of India, flow of funds accounts consist a set of account which depicts the flow of funds from various financial sector in the economy during a given period of time. If we look at macro level, then we can see that entire financial system of India is divided into formal and informal, and most importantly both the sector play an important role for the inflow and outflow of fund is concerned. But no doubt in saying from the recording of transactions, formal financial sectors are easy. Because of them there is appropriate regulatory body and other government agencies who exist in the country for proper functioning as well as controlling the affairs of these institutions. But relatively for informal financial sector, there is no such regulatory bodies exist to deal with the affairs of these institutions. That is why, for the sake of simplicity, informal financial sector is not taking into account to the extent because of inadequate data is concerned. But it does not mean that all the informal financial sector is excluded, though only those informal financial sector who works beyond the purview of regularization aspect. As per the requirement of flow of fund account is concerned, the financial sector is considered as institutional units in Indian economy, and therefore it is grouped into the following categories: banking, other financial institutions, private corporate businesses, government sector, rest of the world, and finally the household sector. On the other hand, financial instrument of these financial sector broadly comprises assets and liabilities of these institutional sector is further grouped into currency, deposits, investments, loans and advances, small savings, life funds. The following data of flow of funds accounts are taken from the RBI database sources just to understand the presentation style as well as necessary information that a flow of fund accounts contained. Flow of fund accounts of the Indian economy, just as a hypothetical example for the year 2010-11 and 11-12. December 10, 2013. In this segment, information is given about the net savings and net investment from different sectors such as private corporate sector, public sector, household sector, and other information are presented from 2008-9 to 2011-12. Net savings and net investment of different sectors as percentage of NNP at current market price, 2003-4 to 2007-8 average, 2008-9, 2009-10, 2010-11, 2011-12 standalone numbers. First one is private corporate sector, net saving, net investment resources gap, which is the difference between 1 and 2. The respective numbers are given to you. Resource gap you will find is going into negative. Public sector, net saving, net investment resource gap 1 minus 2, again you will observe that it is negative. Third, household sector, net saving, net investment surplus 1 minus 2, as you observe that each and every figure in the surplus column is positive. Fourth, total, net savings, net investment resource gap 1 minus 2, for the average it is positive and for standalone year it is negative number. Fifth, valuables. Sixth, error and omission. 7, adjusted resource gap, which is overall a negative number. Note, savings and investments are shown on net basis, adjusting for consumption of fixed capital. In respect of the household sector, this means CFC is excluded from their gross investment in physical assets. The financial saving of the household sector are always reported after netting out financial liabilities from their gross investment in financial assets. Second, the resource gap may be adjusted for capital transfers, generally unrequited and non-recurrent transfers which are designed to finance the gross capital formation of the recipient and made out of the wealth or saving of the donor, though these have been usually small. Source is the Central Statistics Office. Sectoral trends in flow of funds. Now, private corporate business sector, table 3, financing of private corporate business sector. The figures is in billion. 2003, 4 to 7, 8 is an average in US dollar. Then 2008, 9, 9, 10, 10, 11, 11, 12 is given in standalone numbers. Broadly, the information is on financial sources, financial uses, financial deficit. Fourth, deficit financed by net issues from the following sectors: banking, other financial institutions, government, rest of the world, household and others. Similarly, the government sector, table 4, financing of the government sector, same, 2003-4 to 2007-8 average in US dollar. 8, 9, 9, 10, 10, 11 and 11, 12 standalone numbers, items, financial sources, financial uses, financial deficit, which is the difference of 1 and 2, deficit financed by net issues from the following sectors: banking, other financial institutions, government, rest of the world, households and others. Household sector, the data is also for the same time period and in the same lines discussed above. Banking sector, other financial institution sector, instrument wise financial flows. Financial flows by type of instruments, that is table 6. Years is same, 2003, 4 to 7, 8 average, 8, 9, 9, 10, 10, 11 and 11, 12 standalone instruments. Number 1, currency and deposits. 2, investments. Within investments, central and state government securities, other securities, of which all mutual funds. Loans and advances, number 3. Number 4, small savings. Number 5, life funds, provident funds, trade debt, foreign claims not elsewhere classified, other claims not elsewhere classified, and the last one is total claims issued. Select indicators of financial development, table 7. Year is again same, 2003, 4 to 7, 8, 8, 9, 9, 10, 10, 11 and 11, 12 standalone numbers. Secondary issues, primary issues, within primary issues, domestic sector, rest of the world. Then third one is total issue, which is a summation of 1 plus 2. Net domestic capital formation, national income, finance ratio, financial interrelation ratio, new issue ratios, intermediation ratio, growth in real GDP at factor cost. One can see the graph from 2001 to 2002 to 2011 and 11 financial development ratio. The red line is of financial interrelation ratios, pink line financial ratio, green new issue ratios, and blue is intermediation ratio. Summary. Flow of funds is the summary of all financial transactions within and outside the country at a particular time period. Flow of fund is not merely an indicator for financial planning and controlling, but also a social as well as economical device which is taken into account to improve the living standard of people. It has direct relationship with the economic growth and development. In short, one can say that flow of fund account is nothing but a statement which systematic records the transactions occurred inside and outside of any country for a given time period.